Hey, what's going on, everybody? Welcome back. So, today we are going to talk about how to know if you are ready, if you're ready to become a home buyer. So, my name is Nichelle, and I have been a licensed broker for about 22 years or so, and in the business of real estate over 33 years. And so, I run into a lot of people who are interested in purchasing a home, but they just don't know how to start, where to start, and when to start. So, I'm going to give you a rundown of about 9 things to help prepare you for home ownership. Home ownership can be a heavy burden for someone that is not prepared. It can also be a heavy burden for someone that doesn't know exactly what to do. And the first step in purchasing a home, you must understand credit. You must know what your credit scores are. There are 3 agencies that you should be mindful of. That is TransUnion, Experian, and Equifax. Those are the 3 main branches of credit bureaus that typically gather our scores and make an accumulation based upon how you've paid your bills. And when you are preparing to purchase a home, my suggestion is that you start looking at your credit, assessing your credit about a year to 2 years prior to. And I'm going to say more so for 2 years because at the 2 year mark, you have some idea of what you are interested in doing as far as purchasing a home. So, the cool thing about the credit is that upon deciding that you're ready to purchase a home, you could get a free annual credit report from annualcreditreport.com every year. And they will give you those 3 main branches that I discussed with you, the TransUnion, Equifax, and Experian. Obtaining a credit report and reviewing your credit score really will give you some type of leverage and some type of identity as to what you can literally afford. Now, not creditors, but mortgage lenders, they don't look at just your credit score. They look at how you pay your bills, how much you make, and they assess what you can afford based upon those things in your debt to income. And we'll discuss that a little bit down the line here. But they look at all those things because it is important to see what you can afford. Because I tell my clients all the time, you don't want to be house rich and poor, excuse me. So a good credit score is essential for qualifying for a mortgage and obtaining favorable interest rates, because the interest rates really will determine your debt to income for your house. Look for any errors on your credit report. A lot of things you can fix yourself by writing the agency and making them aware that you did not know what was on your credit, or you did not know where they came from, or you paid it off, something along those lines. You can definitely reach out to the credit bureaus yourself and write to them, and they expect something back in writing within 30 days. You can also hire someone to do that, a reputable source, a reputable company that can assist you in credit rehabilitation. I don't necessarily believe in credit repair because it's kind of hard to repair something that has been broken without consultation. And so within our agency, we do offer credit restoration. And in our credit restoration process, it's basically making the new future home buyer aware of where their credit is and what they need to do to get the scores up. So you could typically buy a home FHA with about a 580 credit score. I've even heard it go as low as 500. And if you're a veteran, there's many different types of loan programs out there. The most popular is the FHA, Federal Housing Administration, and then you have the VA for Veterans Administration. Those are the 2 most popular loan programs that we typically work within. And there's also conventional. The conventional, they have a little few more, strings that you have to pull, and you also have to sometimes put a little bit more money down. Versus the FHA typically asks for about 3 to 3.5% to put down to purchase a home. And for first-time home buyers, that typically is within the range of what they can afford. The second thing that you need to be mindful of is that you need to calculate your budget. And what I mean by calculating your budget, you need to prepare for things that happen within home ownership, like the utilities. And one thing that I always recommend to new home buyers is when they are finding a house that they want to purchase, you can call the utility companies and get an average of what the utility bills are for that property. Simply give them the address, let them know that you're in the process of purchasing it or thinking about purchasing it. You just want to know what the average amount is for the utility bills. And so evaluating your income, your expenses, and any existing debts that you owe will literally kind of give you a leverage of what is affordable for you. Again, I go back, do not be house rich and poor. Calculating your budget in advance is so important for many reasons, because you know what you make, you know what you can afford, you know what you like to do, and you definitely want to have some kind of leeway as far as money is concerned to still enjoy your life. The third thing that I would recommend is that you save for a down payment. Now, as I mentioned, FHA typically requires about 3 to 3.5% of the total percentage of the house. If you got $100,000 house, then you got to put 3.5% down for that. That's what they typically ask for. If you get qualified for a conventional, they will typically ask for anywhere from about 4 to 10% down, I've seen, and sometimes even 20%, depending on the situation. I've also seen VA with zero down. And so being the VA offers zero down, you do have to be a veteran or I think a spouse of a veteran in order to qualify for the purchase. No, excuse me, you just have to be a veteran. You can't be the spouse of a veteran. I'm not sure on that. So that's something I need to get clarity on as well. But I know definitely you have to be a veteran in order to get a VA loan. And so when you calculate your budget, you add all of the different obligations that you have in there, and then you can wage whether or not if the price of the house is what you can afford in your budget. Saving for that down payment, determining the amount of the house that you can afford. As I mentioned, anywhere from about 3% to 20% is typically what you will ask for. Utilities, if you have a car note, things of that nature, you want to save for a down payment, because that will literally not necessarily take money away from what you have or what your mortgage will be, but it will help with the process of you purchasing a home and, lessen what you have. So there are closing costs involved when purchasing a home as well. So some of that money you save will definitely go towards that. I also mentioned that you want to consider other costs associated with purchasing a house, like taxes, the closing costs, appraisal fees, title fees, attorney fees if you live in a state that an attorney does, and moving expenses, possible renovation costs that you may want to go in and rehab the house if it's not one that's already rehabbed. You have to weigh all those things in. And then again, the utilities, which are very important, your current bills that you currently have right now, cell phone bill, charge cards, and things of that nature. So when the lender gets your information, he will pretty much put those things in perspective. But again, no one knows total what's comfortable for them outside of you. And the lender, I remember when I was first approved for a house, they told me that I qualified for, I think it was a $750,000 house. I know I did not want no $750,000 note, because when I purchased my house, note was the interest rates were like about 14%. Go figure, okay? So right now at 7%, they're really good, and I tell people to jump on them. In fact, when the rates dropped down to about 3%, we end up refining again, and I'm telling you, that was like a light bulb went off, and I'm like, yes, I got extra money to breathe, because you're gonna pay your mortgage. You got to have somewhere to live. And so considering other costs when you're calculating the purchase of a home really will help you, not only short term, but long term as well. You also want to be mindful of your debt to income ratio. And you will hear in our industry, or the lending industry is called DTI. And so what basically is your debt to income is basically what you make minus or subtract what you owe. And so if you make $3,000 a month and you have $1,000 in bills, the lender would definitely take that in perspective. And a lower DTI ratio is generally more favorable to a mortgage lender. And I think they look at like 30 to 40% of what your mortgage will be to say if that's something that you can afford. And so knowing who you owe, what you owe, and then calculating your current house payment in there literally will give you your debt to income ratio. You also want to secure a pre-approval for a mortgage. So even before you go get a realtor, even before you decide to purchase a home. You need to know these things prior to, and then you get you go to secure a mortgage. And in securing the mortgage, the lender will ask you for all your life story, how much you make, paycheck stubs. You typically have to give about 2 years of income, meaning W-2 income, or whatever type of loan you're qualifying for. They want 2 years of taxes that you file. They also will typically ask for about four paycheck stubs. So about 2 months worth of paycheck stubs. They will typically ask for that. They will also ask you in most cases to seek insurance, homeowners insurance, to see how much, whatever the house that you're thinking about buying, how much homeowners insurance would cost for that. That's another added cost to purchasing a house that you need to be mindful of, homeowners insurance. Because if you have PMI, which is principal mortgage insurance, typically that goes with an FHA loan, and that will kind of cover some aspects, and that typically almost makes your interest, your payment a little higher because they're including that mortgage insurance in there. And from my understanding, that if you pay it off in a certain amount of time, that typically drops off. I'm not sure what time frame it is, but it typically drops off over a period of time. And so you also of course, need to add that in there when you are securing a mortgage. So pre-approval helps you get a realistic budget of your home search. And upon getting that, they will look at your credit history. Again, they'll determine your income, how much you make versus what goes out, any type of assets you have included as well. And so another thing that I want to make you mindful of, and excuse me, I'm looking at my notes here. You also want to create an emergency fund. Why is an emergency fund so important? Anything and everything can happen when you are a homeowner. Most people, when they purchase a home, I always help my home buyers or negotiate within a contract that they get a home warranty. And I'm gonna tell you why it's so important to get a home warranty, because it seems like every time you move in, people that I know moving the house, even myself, within that first year, something's going to happen. Whether it's appliances going out, whether it's something happening with the house itself, things happen. And so it's important to have that emergency fund set aside before buying a house, because it's essential to have that just in case something happens. We always say, as far as if you're, looking for, security money, as far as setting aside 6 months of income or a year of income, you want to think about the same as far as an emergency fund is considered. You also want to consider your future financial goals. As I mentioned, you don't want to be house rich and poor. I mean, that's like literally death, okay? To be house rich and poor in a house that you like and love, but you can barely afford to live there, because obviously if you can't afford to pay your house note, you and the bank own it, the bank will take it back because they will see that you're missing your payments. And so if you're already renting right now, think about adding that rent with taxes included, because typically taxes will be included with your mortgage payment, plus the insurance that you will have to pay on an annual basis. If you break it down monthly, you'll see what the average cost is for that. You also want to be mindful that if you have homeowners association dues, because those are also a fee for owning a home. And then the utilities, as I mentioned too. So consider your future financial goals. Do you want to go back to school? Do you need a car in the future? Do you like to travel? Financing your house as far as furniture is concerned. Don't go get no loans. Don't get nothing when you're in the process of purchasing a home. That's how most deals are killed. Okay. So when you are purchasing a home, you basically will become non-existent to anything else. You need to focus solely on the home buying process. And that means don't go buy no furniture until you move in the house. Okay. Don't get no new car until you move in the house. That's so very important. I've seen so many people get declined for the home loan when it came time to close, because see, the lender is going to pull your credit when you decide to purchase a home, when you give them the information and release that information. And they're also going to pull it, some pull it in between the process, and then others pull it at the end, before you get ready to close. They're going to make sure that your credit score is still the same, that you haven't gone out there and gotten in any more debt. So it's so important to just stay straight and narrow when you're in the home buying process. And then the last thing that I want to share with you, which is really, really important, is be realistic. I can't tell you how many people, when I am helping them to buy a home, that they tell me that they want 5 bedrooms, 2 baths, and their budget only allots for 3 bedrooms, 2 baths. Now, granted, you may possibly be able to find that, but is it in your budget? And that's why it's so important that before you go out to look for a home, that you take care of these steps that I mentioned, these 9 steps, being realistic, being objective, being okay if it's not your dream home. A lot of times people are like, well, I don't like it because it's not my dream home. Is this going to be the last home you live in? If not, then we need to find something that's within your budget, within the budget of allowing you to live and be a homeowner at the same time. So be realistic, things that you can afford. Don't stretch yourself so far where it's a tight squeeze, especially when the utility bills come due, life comes due, grocery comes due, things of that nature. Home ownership is a long-term investment. Home ownership, if you're not going to stay in a home at least 7 years, then I'm going to say home ownership may not be for you at this time. And it may be possible that you can just still rent, because home ownership is a long-term investment and you literally don't see the transaction being able to be satisfying to you until about 7 years. That's when you start seeing the payments that you've been making come off the total amount of the loan. I mean, it's not a short-term process. And that's why I mentioned, if you're not going to stay there at least 7 years, then perhaps maybe home ownership is not for you. Overall, making sure you assess the readiness of your financial situation is so key on so many levels. Making sure that you can afford what you're looking for. And it's okay if it's not. It's okay. Save for it. Because home ownership can literally be unexpected. It can be damaging to you if you're not prepared for it mentally, physically, and financially. And so that is my information for you today in this home buying process seminar. I hope and pray that it answered some of your questions as far as assessing your financing. What do you need to do to get prepared? And the last step upon completing these 9 steps is the 10th step, and that is find you a reputable licensed realtor. And a realtor can help assess a lot of things for you: marketability of the house that you're looking for, the neighborhoods, the areas. Some things are responsibilities of the home buyer, but as a realtor, we have to give our due diligence to you, the home buyer. And that's why it's important for you not to only be honest with us, but also be realistic and be mindful of what it is that you're getting yourself into. So my name is Nichelle. Go ahead, and if you're not a part of my family, go ahead and hit the subscribe button to become a member of the family. And I hope this information helped. If you got any questions, go ahead and put them below so that we can go ahead and get that answered for you. Also, let me know what state you're in, because I'm only licensed in Georgia and in Missouri. But if you need someone in your area, I do have a referral network where I can assist you in getting some assistance in the area that you're hoping to buy in. So thank you so much for being here. I'm Nichelle. Again, take care. If you're not subscribed to the channel, go ahead and click that link in the bio, or click that subscribe button right there, and become a part of my family. Blessings and peace. Until next time, take care. Bye.